buy stock. But he hasn't bought any stock yet, you know where it is. That stock purchase was May of last year. So there's a little extra cash that building up that didn't go into buybacks. So that's a little bit. A more important factor is, several years ago, he established a very big position in Apple. He's been reducing it significantly. Apple's been a great stock for him, and I think he should take some money off the table. He's had a history of not investing in technology stock. That's an unusual investment for him. He doesn't understand technology, and he doesn't want to own things he doesn't understand. So between the two of those, that has something to do with his position. Now I want to pull this up for a second. Okay, Berkshire Hathaway is a $1 trillion market cap company. One of the 10 largest companies in the S&P. It's actually 10.051 as of yesterday. So to move the needle for Warren Buffett, he can't buy small companies. He can't even buy medium-sized companies. He's got to buy something really, really big. So this is a Morningstar style box. It applies both to managers and to companies. I'll explain it. This is the value column for companies or investment firms that are value oriented. If you're growth oriented, you're over here. And in this axis, large caps, mid caps, small caps. Or you could even add mega caps and micro caps, but we don't need to do that. So this part is not available for Warren Buffett. And this part is not available for Warren Buffett. And most of the large cap stocks, right here, large cap growth, technology. Look at all the tech stocks in the top 10. Those are expensive. He's not going to pay. He's a value manager. He wants to buy over here. So what's going on? He's saying the market's expensive, but he's also saying the kind of stocks that I want to buy, really large companies, I can't buy them. They're too expensive. So he's waiting, and he's waiting, and he's a patient guy. I've been kind of nervous about the market the last 2 years, and I've been wrong. And but he's hanging into his cash. So it's an interesting situation. He's a very smart guy, but he's also cautious. Yeah.
Why do you say he can't buy medium caps?
Because they won't make any difference. It's such a big company. Their net income is so large. Those companies are going to be 2% of their net income, or maybe 5%. They're just not going to. They're not going to make any difference because it's such a gigantic company.
Yeah.
It's a monstrous company. It's got a lot of different businesses, and it's a very complicated company. But interesting enough, when he buys a company, the management stays in place. The corporate office at Berkshire has about 20 employees. There's a company worth $1 trillion, with 20 people running it. I mean that, but there's a lot more people. Each operating division has people, So the whole market's not there for it. He just can't do it. Now he said something about 1985. He came out with his annual report. Says that we're outperforming. We're doing really great, but at some point we're going to be too big. You get too big, you can't grow fast. You can grow, but you can't. The law of large numbers eventually kicks in, and you just things are going to change. Yeah,
Has he thought about splitting his company apart in order to take advantage in one particular company, or is it too expensive to split up all that stock?
Well, that's an interesting question. In the history of corporate split-ups in our country, usually the pieces are worth more than the whole. I mean, go back to Standard Oil, and go back to AT&T when they broke up AT&T. The 7 Arbucks came out. I don't know if they've thought about that. That's a good question. That's something for the new you know, he's resigned at CEO position, so that's something for Greg and Abel to think about. But I've never heard anybody mention that, but it's a complicated company, and sometimes companies are better off individuals. They get a higher multiple sometimes. So complicated companies are hard to manage. I follow Melville Shooting, they had a 20%, it's a great company, but there was about 6 different retail chains. It was hard to value it, and nobody gave them much credit, even though they were doing great. And then eventually they screwed it up. Any other questions? Anything's fair game.
Where do you get your money to buy that large, high value stuff?
Well, when you say high value, there's high price and there's high value. They're not the same.
I'm looking at
The upper right.
left-hand corner.
They don't have, they're expensive stocks from a price to earnings. They may not be expensive in terms of absolute price. We have to distinguish between, when I say a stock's expensive, I'm not saying it's $1,000, I'm saying it's 45 times earnings. You could have a stock for $1,000, the earnings are 100, and the PE ratio is 10, the market's over 20. So when we say expensive, we're not talking about the actual price itself. It's the relationship of the price to the earnings.
Switch gears once. I've got some Franklin Templeton investment, mutual fund. Pays about 6%. And it's steady. But then I look at, it's got a low,
Okay,
yeah. But then I look at like BIT, which is BlackRock, I forget what it all is, but anyway. It's got a higher, reinvestment cost, but it's paying more like 8.5, 9, somewhere in there. My broker, who's now retired, which he put me in that Franklin Templeton, she says, don't ever get out of it, because that's Class A1. You wanna stay, you wanna stay, you wanna stay. And I'm not knowing what the real advantage to Class A1 is, and I'm not knowing why in the heck I should be costing myself 2% in dividends and not switch that over to BIP.
no, I'm not that familiar enough with the circumstances.
Well, the A1, what's the difference between an A1 and an A?
In terms of,
Uh,
what does that refer to?
I assume that it has something to do with,
Sometimes when there's multiple
The
classes of
cost.
stock,
The
there's multiple
cost.
classes, there's different charges for different classes. I suspect there may be multiple classes in this case, where they may pay different amounts in terms of this expense
we pay
ratio.
the same dividends.
But I'm thinking the expense ratio. might be
Yeah, the expense ratio is what I'm thinking.
You know,
Is different.
lower's always better than high, of course. David?
You may have already given some thought to this, or have Monmouth moving this direction, but I was thinking about Monmouth's foundational funds. And,
Endowment?
the endowment,
Yeah.
and you've got, your compelling information or sheets here, say that you really should invest, it sounds like almost 100% in index.
We have a lot of money in the S&P.
But almost 100%, and.
It's not 100.
But, because we're gonna be here 40 years, or at least on our plan, well, then we'll have a return, we'll take 5% or 7%, whatever it might be every year. And is that the plan for, that Monmouth uses?
Yeah, we take up 5%.
In other words, it's plan to do an index fund with low cost?
Part of it's an index, but not all of it. We have active managers too.
And so how are those, I'm sure you're looking at various.
We have a consultant, Cap Trust, who we've had for 20 years. We work closely with them, and our investment committee has several really experienced people, so we can keep them honest.
No, I don't think they're not honest.
No, I mean,
Looking at to see.
I mean honest in terms of, we understand exactly what they're doing and why they're doing it.
And so you're getting better, a good result as index funds from the active manager?
Yeah, we're very close, our active
Okay.
managers are very close to this.
Thanks.
I want to preface this by saying I'm not one of these people. I'm perfectly happy to buy my stuff and let it sit, we write it out, I see the 100 years and so forth. But I have friends and relatives who panic. And right now, they're pulling their money out of stock, or, well, they were in April, I'm not sure what they're doing now. But if you're talking to people like that, and you know you can't convince them to tolerate any volatility, as I think the world is volatile.
Yeah, so we're,
For sure.
yeah, no question.
What do you say to them?
I think
Bonds?
you may say you own too many stocks if you want. I mean, my rule is, if you can't sleep at night, whatever you own, you
Yeah.
shouldn't own it.
Yeah.
If it's keeping you awake, you shouldn't own it.
But you tell them, well, consider a combination of bonds.
Well, you do a 60-40, that's the most common, 60% equity, 40%
Yeah,
bond.
but they're just too scared of the equities right now.
Then you do a 46, or
Like
47,
28.
you know, whatever, wherever they feel, you know, you shouldn't have all your money in bonds. You shouldn't have all.
Yeah.
So, you gotta take some risk. You have to accept some value, you know, maybe you keep it 20%. Whatever allows you to
Allows
sleep.
them to see, okay.
Yes, sir.
Thoughts on gold versus gold mining stocks?
Yeah,
I have a position in some gold mining stocks. I kind of like gold, and I've never been a big fan of gold. But I think it's, our government's spending a lot of money, more than they have. And I feel comfortable owning a little gold. I worry about our debt and how fast it's growing as a country. And I watch the bond market closely, because actually bond market investors, I think, are smarter than stock market investors. They seem to sense things sooner. And if there's gonna be a problem with the bond market, gold is gonna go this way. And, you know, bond, the 10 years, kind of, it's going sideways, a little up, a little down. You know, the president wants it to go down, and the Fed says, let's see some more evidence of tariffs are gonna be inflationary, but we don't know how long they last. There's tremendous amount of uncertainty, and I think the Fed just wants to stay put and see how things unfold and look at the numbers as they come up, the unemployment numbers and the inflation numbers. They've got two jobs to do, keep inflation down and unemployment low. And sometimes there's some tension between those two.
Yeah.
Some of you may remember back in like 1980, there was an index that came out called the misery index. And it was the unemployment rate plus the inflation rate. And in 1980, 81, the misery index was over 20. So we either had double-digit inflation or double-digit unemployment, or maybe both. And now the misery index, you know, inflation rates 2.5-ish, the unemployment rate's 4.2, we're talking 6 plus, 6.5 to 7. That's a lot different than 20 plus. So there, you know, there's a lot of, you know, the economy's still relatively healthy. We don't know the future, but you should know, my favorite phrase about Wall Street, often wrong, but never in doubt. You watch CNBC and these analysts, oh, this is gonna happen. Well, sometimes it does. Most of the time it doesn't. Any other questions? Yes,
So just kind of, I mean, at Monmouth, we teach a personal finance class, but not all students take that class. But, you know, and that's, you two can talk about what the curriculum is.
I taught that class across.
Did you? Yeah,
I
I
enjoyed
was gonna say, and some of that is just basic finance, personal, you know, finance,
Yeah.
checkbook, mortgage, how those work. But tell us what you think young people need to know about investments before they leave.
Well, I think they need to understand the difference between stocks and bonds and cash. And there's a lot of permutations under each of those categories. So they should kind of understand what the role of the stock market is. It's related to the economy. Companies that do well go public, and that market allows all of us to invest in some really interesting, successful, well-run companies like Apple and Amazon and Alphabet and Berkshire Hathaway and HCM. There's a lot of well-run companies out there. I think they need to understand how the stock market works, what their alternatives are in terms of investing. And they need to understand IRAs, they need to understand Roths. One of the things I didn't mention, you could buy a mutual fund or you could buy an ETF, an exchange traded fund. Vanguard's got both. A lot of companies have both. You want to own the ETF. That's where you want to be, not in the fund. The ETF rarely, if ever, has a capital gain distribution. Funds have capital gain distributions all the time. They're structured differently. So the ETF can avoid giving you a 1099 at the end of the year, big gain. And some of these mutual funds, they'll give you a big capital gain, even though they've lost money for the year because they've realized they've sold some stocks, made gains. You pay taxes even though you lost money for the year. That's, hedge funds are the same way. You really feel pretty. I lost money and I owe money, it's not. So when you're looking at, if you decide you want to invest in the S&P, go with the exchange traded funds, not the mutual funds.
Are you saying capital gains are bad?
I'm saying realized capital gains are, I'm not saying they're bad, but you'd rather not have, well, you want to have gains. I want to pay $5 million in tax this year, because that means I've made 10 million. But I'm not going to pay, that isn't going to happen, of course, but, that's it,
Well, sometimes, you're looking at, cash flow and paying
Yeah.
expenses, whatever, and so you get a capital gains, let's say, of $20,000, and you owe some tax on that, I expect to pay tax on that. But now I've got, say, $17,000 left to do what I need to do, pay a car loan.
they're not bad, but you'd rather not have to pay taxes. And if you look for ETF versus mutual fund, you definitely want to be an ETF. If you're going to own the same stocks in the same percentages, the fee's going to be identical. Everything's going to be the same, except you're not going to get any realized capital gains. RSP up here, I don't, they're over 20 years old. I don't think they've ever made a capital gain. They're equal weighted. Yes, sir.
Isn't it fair to say that what a young person really needs to know about financing is the power of compounding?
I would totally agree, yeah.
Yeah.
I was gonna say, our kids need to know what debt is all about and how much it costs.
Yeah.
Yes.
But there's, this group right now, the Gen Zs they're the 2008 economic crisis babies. They have such a fear of money, more so than other generations. Their fear of debt, and
Well, fear of debt's not bad.
Yeah, exactly, yeah, so those are the things, so things like compounding, how do I say, be like, oh, I'm not getting a credit card, you only get in trouble with those, because I witnessed some of that
Yeah.
in their own upbringing.
But Bill, don't they need to understand though, the difference between personal debt, corporate debt, and government debt? Each has a role in their
Yeah,
lives.
each does have,
Yeah.
personal debt, you kind of like that low. The corporate debt, if you have too much, like what's a company like this, they lose their flexibility. So as an investor, you don't like to see highly leveraged balance sheets, particularly in a cyclical business. That just makes no sense. Any other questions? Thank you all. I'm here if you want.
I did have one more.
Okay, go ahead.
What if your money is in retirement funds anyway? So your capital gains, you're not paying taxes on it. Do you still advise ETF over mutual funds?
How, what form is it? It's money you have control over.
Well, they're in IRAs.
Okay. It's not a Roth IRA.
No.
So you've gotta make
The
required
old-fashioned.
minimum distributions every year. So what, I'm sorry, what's the question?
So the question is, your advice to do ETFs over mutual funds, if you're not really paying taxes on the mutual gains, excuse me, the capital gains anyway, is it still your advice to do ETF over mutual funds?
It probably is coin flip. It probably doesn't make any difference. Mike, any questions?
I have a comment.
Oh, go ahead.
I have students come in my class, some of them don't know what a corporation is, and others are day trading.
That's
And they're all-
quite far apart.
We have students who are day trading.
How are they doing?
Hopefully they're paying this.
Some advice is to buy a home as soon as you can. As opposed to paying rent.
You hear that, Pat? He
Yeah.
said, buy a home as soon as you can. So you're not paying rent. The building, that's it.
No, I just want to share this with the audience. So Bill has come and spoke to my investments class almost 30 years I've been here, and they absolutely love it. But one time he came in and I had this kid set up, so I don't remember this. He says, he asked Bill says many questions, and he goes, yeah, if you know so much, how come you're not rich, tough guy?
And do you remember my answer?
How do you know about it?
How do you know I'm not? Right back at you, buddy. Thank you all very much. I'm available.